That's the description you have. How would you go about thinking, how can I put a price on this option? What is my cost of hedging this once I give you this option? So let's go through how I would hedge it. At inception, on day one, at the start, let's say that spot is 120. And for simplicity, let's say that spot is equal to the forwards. So this is the 50 delta option. So the probability of exercise is half and half. I don't really know if the market's going to go up or down. I think it's 50-50. So on the hedge, I'm going to go and buy 50 million euros. Why am I buying 50 million euros? Because I gave you the right to buy 100 million euros. In 6 months' time, you could come to me and say, give me my 100 million euros at this rate. Likelihood is 50%, so I go into the market now and I buy 50 million euros on the market. Tomorrow I come to work, next day, and spot has moved up to 125. What does this mean for the likelihood of you exercising your option? Your probability has gone up because you've got the right to buy at 120, and the market now is at 125. So the probability has gone up. Let's say the probability has gone up to 75%. You had 50 million euros on the hedge already, so you need to buy another 25 million euros so that you get to 75 million euros. The following day, you come to work and the spot has completely dropped in the other direction at 115. What has happened to the probability of exercise? That's gone down. Let's say it's gone down to 25%, but you're sitting on 75 million euros. You only need 25, so you sell 50 to get it down to 25. So what's going on over here? Every time spot goes up, what do? And every time it goes down? Is that a profit-making proposition? No. So you're guaranteed, me as a trader, I'm guaranteed to lose money chasing the market. I'm buying when it's up and I'm selling when it's low. So I know that I'm definitely going to lose money hedging this. I just need to try and figure out by how much. And if I do, then that'll be how much I will charge you for it. So long the option, long the gamma, short the option, short the gamma. True for calls, true for puts, always the case. Long the option, vanilla option, different for knockouts. Long the option, long gamma. Second thing to note is that the risk is non-linear, which means that you can't just do one hedge and forget about it for the next 6 months. I do one, I see where market is, and I have to do it over and over again. So the cost of hedging, therefore, is a function of how many times I have had to rebalance my delta. How many times did I buy high and sell low? The pain is, as somebody who's short gamma, if it goes in two directions, or the number of times it's expected to go in two directions, is the volatility that's going to cost me. You have the price of future expected volatility that's looking forward, which is the volatility that's traded between option traders in the market, and that's implied volatility. And then there is the other volatility, which is the actual realized volatility in the market after the fact, which has actually been experienced. So realized volatility is after the fact. Implied volatility is what I need to guess before it happens. And implied volatility is the metric on which option prices are made. If you bought an option at 10% vol, immediately afterwards, the market's assessment of future volatility goes up to 11%. Actual volatility doesn't have to move at all. It can be the market is exactly the same, maybe for policy announcements and some other reasons. The market's price of volatility has gone up from 10 to 11. Then the mark-to-market of your option will go up, and that's why you're long of Vega. But if realized volatility turns out to be 9%, then you will likely make money on that trade. Because actually, there was 9% real move, and so you were only chasing the market that many times. Whereas when you did the trade at inception, you were expecting to chase it even more. And so you could be completely neutral on the underlying market, have absolutely no view on where it is, but purely trade expected volatility versus realized volatility. So there's two things that we need to keep in mind. One is, how much time do I have to exercise this option? The second thing is, where am I in the underlying market relative to the strike? So imagine you are sitting on the strike. So 120 was the strike in our example, and its expiry today. 3 o'clock this afternoon is going to expire, and it's 2 o'clock right now, and I'm sitting on the strike. Spot moves a little bit to the upside. There's a very, very high chance the option will be exercised. So I go and buy 100% of the delta. Spot moves a little bit to the downside. There's a 0% chance of it's going to be exercised. So I go and sell 100% delta. I'm zero delta. So you could, in theory, move from 0 to 100 very quickly if spot is on the strike and time is very close to expiry. So gamma is the highest when you're on the strike, at the money, and you've got very little time to go.